Well, let's pick up on that point because small caps certainly have been in the doldrums. I want to bring in Ross Mayfield, investment strategy analyst at Baird. Ross, how do you think about this sort of recovery that we are seeing at a time where, you know, we got to think about, I'm just doing the numbers right here. Certainly small caps got punished to the downside a lot more than sort of those larger players.
Yeah, I mean, you think about it, smaller businesses are going to be hurt even more than the big ones by higher rates and higher inflation. You know, it's not small cap stocks, but you look at the small business surveys, and they've been talking about this for years. Obviously, accessing capital markets is a lot more fraught for the smaller cap businesses. And then the sector mix is more challenged down the cap scale as well. A lot more regional banks, smaller biotech companies, stuff that hasn't been working nearly as much as mega cap tech. So this recent rally, it's what you want to see, right? We've been talking about this narrow rally all year. You want to see a broadening out, and a return to small cap outperformance might, you know, be the spark or the sign that there's a broader rally coming. I would be hesitant. I would not chase small cap and speculative outperformance here because the Fed is saying that rates are going to be elevated. There are structural forces keeping rates elevated. If rates and inflation remain elevated, even in a soft landing scenario, that's still major headwinds for small caps that I think are hard for them to hurdle.
That's interesting. So the valuation, the pullback, the fact that it's kept pace on the upside with the U.S. markets, your strategy is still skewed to those larger cap players?
I think so, yeah. As we head into a slower growth environment in 24, where interest rates we expect to still be elevated, even if the Fed makes a few tactical cuts, or potentially we shift into a recession, the larger businesses are usually higher quality, or at least have better quality balance sheets. They're more self-funding. They're able to kind of continue on without having to tap capital markets in a challenging environment. And so we would, you know, favor that shift in quality, which historically, or at least in recent history, has been shifting up the cap scale. I think that will bear dividends in 2024. You know, we love to see the rally in small caps. I'd like to see it continue and see this rally broaden out. But I'm just skeptical that it has, you know, durable legs into the next year.
You know, it's interesting because everybody obviously skews towards quality. They come on and they say, I've never really heard, maybe one guest says, I want to buy poor quality companies. But having said that, companies, especially in retail, that have lagged this week are getting these massive one-day rewards for really tepid set of results. But does that speak to an investing sentiment that is willing to pick up names that have been beaten up and cheap, redeploy some capital from, you know, whatever your NVIDIAs of the world into some more beaten up sectors? Are you looking at hunting for those opportunities, stocks that may be poised for inflection points?
Sure. I mean, look, price is always one of the most important components in making a decision. And for those beaten down names where expectations have gotten, you know, pretty low, I think there's always opportunity to go fishing, as long as, again, and not to play into what you're saying, but as long as there's some semblance of quality, that if you buy these stocks and the economy is in recession next year, are they going to be able to survive, or are they going to get, you know, cut in half? So we don't mind the idea, but I do want to be hesitant of grabbing lower quality stuff or more speculative stuff, especially retail and consumer oriented, as we head into what I think will be a more challenging macro environment in 2024. So, you know, places where expectations and prices have gotten beaten up enough, there's always opportunity. But I do want to be investing in sectors and stocks that have the opportunity to thrive in a recession, or to at least survive a downturn here.
How are you thinking about the signal that you're getting from the energy markets right now? This pullback, this slide, today we're bouncing, but it's been generally kind of 4 weeks in a row of declining oil prices. On one hand, may be good for inflation. On the other hand, you have to think about what's the demand picture like if investors are persistently selling down oil.
Yeah, I agree. So, I mean, domestically, you know, obviously it's a good thing if the consumer is getting cheaper gas prices, if companies are able to better manage their input costs. Certainly for consumers in particular, that gas price is a big driver of how they think about the economy and inflation. So if that's coming down, it portends maybe a slightly better consumer picture into year end. But broadly, I think you're right. I mean, it's a supply and demand story. So supply came in above expectations. We've seen a big inventory build. Outside of OPEC Plus, there's been production that has helped bring the supply into better balance with demand. But the demand picture is obviously a big piece of this. And the US has been pretty strong this year, but you look at Europe, you look more globally, and global economic growth is waning a bit. I think you're starting to see that inflect in commodity prices, not just in oil, but in things like, copper or some of the more industrial metals. China is coming back online and there's stimulus there, but I don't think it's quite enough to shift that picture for oil in the near term. And then finally, I would note, there have been some important levels that oil has broken through. So we see some algorithmic selling that's putting downward pressure, obviously a little bit of relief today. But yeah, that global demand picture is still not exactly where you want it, or at least it's not screaming inflection point into 2024.
All right. So a lot of things that you're avoiding, cautious about. What's your high conviction area right now?
We like some of the more cyclical sectors still. I think in industrials, I think in tech, you can get, again, that high quality growth that has a chance to outperform if the economy turns into more of a muddle through situation next year. Those are two sectors where you have a better opportunity to do some stock picking. The sub industries are pretty diverse, particularly in something like industrials. So we like the structural tailwinds there. We think that even if the economy goes into recession, it'll be mild by historical standards. And so those cyclical stocks with a high quality story kind of overlaid on top have potential to outperform. So tech, industrials, and then maybe healthcare as a little bit of a defensive quality story as well.
Ross,